Hi everyone, this is Professor Boucher, and today we're going to be going over depreciation. So let's talk a little bit about what depreciation is. So depreciation goes back to one of our founding principles in accounting called the matching principle. And that's where we want to make sure that the revenue matches the expenses, or put a different way, that the expenses used to generate the revenue are recognized in the same period. So normally, if we go ahead and we buy supplies or pay our employees, that's pretty easy. We pay them in one period and it's taken care of. It matches that revenue. Where it gets a little bit tougher is something with a fixed asset. Think a building or a truck. We're going to go ahead and pay for it today, but it's going to provide a useful life for us for several years if it's a vehicle, or possibly decades if it's a building. And that creates an issue. We need to make sure that the expense for the building only matches the amount of that building's useful life that was used to generate those revenues. So that's where depreciation comes in. Depreciation is going to act as a logical allocation of the useful life of that asset. I keep using my quotation marks here because the useful life is an estimate, right? It may provide a life longer than that, but for accounting purposes, we're going to estimate how long that life is. Another thing that's important to talk about now is to make sure that we understand depreciation does not have a reflection on the fair market value of an asset. So at this point, we may understand depreciation because we may have purchased a car and someone said to us, well, as soon as you buy that car, it's going to depreciate the second you drive it off the lot. And what they were actually talking about was a fair value reduction, not true accounting depreciation, because for an accounting standpoint, when we drove it off the lot, really the useful life has not changed significantly. So it's important for us to understand that for accounting, depreciation is not fair value. So let's go ahead and dive in. XYZ Trucking purchased a new dump truck by paying $10,000 and taking out a $90,000 note. The truck has a useful life of 8 years or 200,000 miles. At the end of its useful life, the truck can be sold for parts for $5,000. So let's start by evaluating the terms that we're going to use. The initial cost. So in the initial cost, it's going to consist of two items. It's going to consist of anything that we paid for cash. That's going to be our $10,000. And also anything that we took out for debt. In this case, we've got an additional $90,000. So we're going to see that our initial cost for this dump truck is $100,000. Then we're going to need to see what our useful life is. The useful life is the estimate for how long we anticipate this asset will be able to provide benefit to us. It's going to either be in terms of time. In this case, it is 8 years. Or it'll be in terms of production. And since we are using a truck here, we see that it could be 200,000 miles. And lastly, we want its estimated residual value. Or often referred to as the salvage value. Which again, in this problem, we see that it is the $5,000. Okay, so we used our important terms here. Now we can go ahead and evaluate it based on different ways of doing depreciation. What we're going to be focusing on here is three main ways. The first way that we're going to focus on is straight line. We're going to come up with one rate, and we are going to recognize that same rate throughout the useful life. The second way that we are going to do it, we're going to use units of production. That's where we're going to go ahead and take whatever the usage base is, in this case it's miles, and we're going to estimate the useful life based on the production it can make. And then lastly, we're going to go ahead and look at a method called double declining balance. That's an accelerated form of depreciation that's trying to recognize that most assets, like this one, say a truck, are going to use up most of its useful life towards the beginning, and as it trails off, it's using up less of its useful life. So we're going to start with straight line depreciation. Again, we're using the information from up here to go ahead and calculate it. So we're going to take our initial cost, which is, I'm going to start shortening these to IC for my initial cost, which was a total of $100,000. Then I'm going to take my residual value, RV, and I'm going to subtract it from it. This is going to give me $95,000. This $95,000 represents the total amount of depreciation we'll recognize over the life of this asset. Then we're going to go ahead and do years. When we're using straight line here, straight line is only going to be done in terms of time. That means we're not going to be using those 200,000 miles. We're only going to be using those 8 years. So we're going to take that 95,000, we will divide it by its useful life of 8 years. And we come up with 11,875. Now this again is my annual depreciation. That's what I'm going to recognize every single year. The next one we're going to move on to is double declining balance. Again, this one is going to be an accelerated form of depreciation. So we're going to start first by determining what was the straight line depreciation rate. So we find our straight line rate. And to figure out our straight line rate, we're going to take the number 1 and we will divide it by how many years of useful life. We in essence get 12.5. This would be percent. And then, as the name implies, double declining, we are going to double that. So we are going to have a 25% double declining rate. Now we're going to go ahead and set up a chart. Okay, so we just set up our chart for determining double declining balance. Let's go ahead and talk about it. In the first column, we have the year. When we talk about year, it's what year are we in from when the asset went into service. So we're only going to do 3 years on this one, even though it goes out to 8. So we're going to see that we're going to have year 1, year 2, and year 3. The cost is going to be what we ended up paying for it, or the initial cost of this asset. For this one, it's not going to change. We're going to continue to recognize it as that $100,000 for each year because that cost never changes. So I'm just filling out a chart at this point. Now I'm going to go ahead and start talking about each of these items. So the first one we have here is our accumulated depreciation at the beginning of the year. So the accumulated depreciation is a contra asset account. We recognize that as a reduction in the value of an asset. So contra asset, it is the opposite or contra to an asset. And with accumulated depreciation, it will always be tied to a specific asset. So on this one, this accumulated depreciation will always be tied to our truck. Whenever our truck gets disposed of, the accumulated depreciation will also be removed from our books. So for this one, the straight line, our accumulated depreciation at the beginning of the year when we first put it into service was 0. Our book value at the beginning of the year, the way we calculate this, we're going to go ahead and take our cost and we will subtract out. I'm just going to put a little subtraction sign right here. We will subtract out our accumulated depreciation at the beginning of the year and equals our book value at the beginning of the year. Since this asset was just put into service, it's still valued at what we purchased it at, or its book value is still what we purchased it at. Now, our double declining rate, that's where we're coming up to here. We had determined the straight line rate and then we doubled it, hence the name double declining. So we're going to go ahead and include our rate down here. It is 25%. Now we are going to recognize that same rate throughout our entire process, so I'm just going to go ahead and put those rates in my rows here. The next column is depreciation for the year. So when we looked at straight line, we calculated the depreciation for the year once, and that's the same amount that we would use for the rest of the life. For this one, we're going to have to calculate a new depreciation every single year. So as this shows, we're going to take our book value multiplied by our double declining rate. In this case, it is 25%. So our depreciation for the year on year one will be $25,000. And now our book value at the end of the year. Now the book value at the end of the year, this is going to come from our book value at the beginning of the year. So we are going to subtract out the depreciation recognized for this year against the book value at the beginning of the year. So our book value at the end of the year for this one is going to be $75,000. All right, let's keep working on it. We'll kind of see how that book value came about in the next step. So we're going to go ahead. That depreciation that we recognized the previous year gets added to our account accumulated depreciation beginning of the year. So we've got 25,000 here. We're going to follow the same process to get our book value at the beginning of the year, but now we do have $25,000 in our accumulated depreciation account. So we've got our 100,000 minus our 25. This gives us $75,000 of depreciation, of book value for the current year at the beginning of the year. You'll see that that $75,000 here is the same $75,000 over here. So following our process across, we are going to take that $75,000, multiply it by 25%, and we get $18,750. Our book value at the end of the year, this is where we will take this $75,000 and we will subtract out this $18,750. So our book value at the end of year two will be $56,250. Now that $18,750, that is going to go ahead and get added to the amount in our accumulated depreciation. So we're going to take that $25,000 that we had previously, we're going to add into it that $18,750, and that's going to give us total accumulated depreciation for year three of $43,750. So when we add that $18,750 to the $25,000, we will get total accumulated depreciation at the beginning of year three of $43,750. Again, following our same process, we will take our $100,000 and subtract the $43,750 from it, which is going to give us $56,250. We're going to take that $56,250, again, multiply it by our double declining rate of 25,000, and our depreciation for year three will be $14,062.50. $2,300,000.50. We're going to subtract that depreciation for year 3 from our book value, and we will get an ending book value of $42,187.50. Now we would continue this process on down till we got to the point that our book value equaled $5,000. When we finally got to $5,000, we would stop. Next, we're going to look at units of production. Units of production attempts to estimate how much of the useful life of our asset was used up by actually using it. So we looked at, for this, our truck, our usage base is going to be miles. So the more miles that are used in any particular year are going to cause more of its useful life to be used up. So let's go ahead and see how that math is done. Using our same items, right? We had our initial cost. And what we're going to do from this, I'm just going to write the formula first. We're going to take our initial cost minus our salvage value. Remember, salvage value can also be called our residual value. And for this, we are going to divide it over our units of production. So let's go ahead and fill in the numbers for this. Our initial cost for our truck is $100,000. Our salvage value was $5,000. And our estimated useful life using the units of production was 200,000 miles. This is going to go ahead and give us 47.5 cents per mile. And that's how much we use up. So let's go ahead and take a look at a couple of years. We're going to have year 1 and year 2. They're going to go ahead and tell us at the end of the year, whoever's driving the vehicles, or perhaps we as the accountant will go and take a look at the odometers. We will take a look at miles used. We'll say in year 1, we used the truck for 30,000 miles, and in year 2, we used it for 50,000 miles. Then we're going to go ahead and take our depreciation per mile or per unit. Since we're using miles, I'm going to call it depreciation per mile. Our depreciation per mile that we calculated was 47.5 cents or 0.475. And then lastly, we will get our annual depreciation from that. So if I go down to year 2, my 47.5 cents remains the same. So let's go ahead and figure out the annual depreciation on year 1. We used it for 30,000 miles. We will multiply that by our depreciation per mile, and that will provide us with our depreciation for year 1. So we had 30,000 miles multiplied by 47.5 cents. We end up with $14,250. In year 2, following that same process, we used our dump truck for 50,000 miles, multiplied by our rate of 47.5 cents per mile. We end up with $23,750. And that's how we would go ahead and complete depreciation using these 3 different methods. I hope to see you again soon.